Wow, this is just absolutely crazy to watch. I'm looking at Qualcomm's stock chart right now, and honestly, it is giving me absolute whiplash. Welcome to today's explainer, everyone. Okay, let's just dive straight into this because we are seeing massive, aggressive stock swings from literally one of the biggest chip makers in the entire world. On one hand, you have people screaming from the rooftops that this is the ultimate undiscovered AI play hiding right in plain sight. They're saying it's the next massive tech boom. But then, on the exact same day, you look at the chart and the stock is suddenly dropping like a rock in the short term. We absolutely need to figure out what is actually going on here because the confusion in the market is palpable.
It is certainly a highly volatile situation right now, but emotion won't help us here. If you look at the data from the recent market reports, there is a very clear, measurable divergence between the company's long-term fundamentals and the short-term market sentiment. Today, we are going to strictly look at the numbers. We will be analyzing their recent Q2 fiscal 2026 earnings data, breaking down their intrinsic valuation models, and establishing exactly what is moving this asset. Furthermore, we need to mathematically define what the core objective of their AI strategy truly is, devoid of the broader market hype.
All right, let's talk about this massive number staring us right in the face, a 48% gain. I mean, a 48% one-year gain is just incredible. It feels like everyone who got into this stock early is currently taking a massive victory lap. But then you zoom in on just the last 30 days, and we've seen a sharp decline of almost 7 to 14% depending on exactly which week you look at. I demand to know, what is the real story hidden behind these headlines? Are people just getting nervous and taking their profits off the table, or is there a fundamental, structural crack in the foundation of this company? The numbers show a very specific dichotomy that requires context. According to the structural analysis provided by Simply Wall Street, the stock gained exactly 48.0% over the past year. If we extend that timeline, it shows an impressive 103.1% gain over a 3-year period. However, the recent 30-day pullback, which hit roughly 14.29% at its lowest point, reflects a market that is suddenly hesitating. The real story here isn't a single catastrophic news event, it is a structural recalibration. The broader market is actively trying to reprice semiconductor stocks that are attempting to pivot away from traditional mobile phones and into the much broader, much more complex AI infrastructure landscape. The volatility is the mathematical expression of that uncertainty.
Okay, let me play devil's advocate here for the viewers, because we are all thinking the exact same thing. Literally everyone and their grandmother knows that AI is the next big thing. It's on the news every single night. So is the upside of all this massive AI hype already completely priced into this stock? I mean, with the stock recently trading around $200 a share, have we already missed the boat? Are we just buying at the absolute top? I need facts, doctor. That is exactly the correct analytical question to ask. To answer it, we have to look past the general enthusiasm and examine the specific valuation signals provided by the data. The metrics indicate that we are dealing with a heavily contested narrative. While Qualcomm is currently trading above several average analyst price targets, its core revenue drivers are fundamentally in a state of transition. We aren't just looking at one unified, monolithic AI market. We are looking at specific subsectors of AI technology that have vastly different timelines for actual bottom-line profitability. So, the question of whether it is priced in depends entirely on which specific AI subsector you are modeling for.
So, break it down for me simply. Let's look at the agenda for today. What is actually moving the needle right this very second? The data reveals exactly 3 real causes hidden behind the news headlines that are directly driving this market volatility. We will examine each. Number 1, conflicting valuation signals. Different verified financial models are literally pointing in completely opposite directions, which creates immense market confusion. Number 2, Bank of America recently released a report pointing out that Qualcomm is attempting to re-enter a fast-growing but hyper-competitive AI data center market, meaning they are facing off against massive, entrenched, established giants. And number 3, which is the most critical fundamental shift, the transition to what management specifically calls agentic AI workloads. This single shift changes the core objective of their hardware entirely.
Wait a minute, doctor. Hold on. That is way too complicated for a normal Tuesday. Agentic workloads, hyper-competitive data centers? What does any of that have to do with our actual stock accounts and our portfolios? Before we get into all that jargon, could you just give us a super simple analogy? Something an elementary schooler could understand about what this company actually does to make money? Let me break this down for you by looking at the core business model. Imagine the global internet, and the massive server clouds are a giant brain located hundreds of miles away. If the cloud is the brain, Qualcomm builds the nervous system and the reflexes for everything else. Their core business model is being the connective tissue. They design the actual physical chips that go inside your smartphone, inside your modern car, and inside smart robotics. We refer to these as edge devices. Their technology allows these specific devices to process complex data instantly, right there in the palm of your hand or on the dashboard of your car, without having to send every single piece of information all the way back to the giant cloud brain to get an answer. Essentially, their business model is making devices smart and responsive on their own. Ah, okay. So what you just said basically means they are the invisible brains and the nervous system hidden inside all our everyday gadgets, making sure they actually work fast and smart without lagging. I absolutely love that. That makes total sense.
Okay, now that we know what they actually do, let's move right into stage 2, the financial and fundamental deep dive. I want to see the hard numbers. Show me the money.
Precisely. Now we must move from the conceptual explanations to the empirical data. We need to critically examine their recent Q2 fiscal 2026 earnings report and run a strict financial statement analysis. We will be focusing heavily on exactly where their revenue is coming from, tracking their operating profit margins, and positioning their cash flow against their direct competitors. Let's look at this chart. Wow, okay. This valuation gap brilliantly illustrates the exact confusion I've been feeling. We have a fair value estimate plotted way down here at $168.50, but the stock was recently trading way up there at $204.13. What on earth is going on here? That is a huge difference. This chart represents the first of our conflicting valuation signals, and it is derived directly from simply Wall Street's quantitative data. What you are looking at is a discounted cash flow, or DCF model. This is a mathematical formula that estimates what a company is fundamentally worth today by projecting its future cash flows and discounting them back to a present value to account for time and inflation. Based on conservative projections within the data, specifically assuming a modest top-line revenue expansion and steady, unchanging margins, this specific cash flow model prices the fair intrinsic value of the company at exactly $168.50. This means, strictly according to this cash flow analysis, the stock at its recent close is roughly 21.1% overvalued. The analytical narrative here is that the headline AI enthusiasm in the broader market might be significantly outpacing the actual conservative cash flow realities the company is expected to generate.
Okay, wait, I get that a cash flow model is predicting the future, but cash flow ultimately comes from actual sales happening right now. So how were their actual sales in the latest quarter? Did they completely drop the ball, or are they making money? If you look at the data in the Q2 fiscal 2026 earnings presentation, they generated an impressive $10.6 billion in total revenues, resulting in a non-GAAP earnings per share of $2.65. But we cannot simply list top-line numbers. You have to look at the specific causes of increase and decrease within their internal segments to truly understand the stock's volatility. Look at handsets, which is their historical biggest engine. It brought in $6.88 billion, but that figure was actually down compared to previous expectations. Why did it fall? Management explicitly cited in the report that major handset customers were actively adjusting their build plans to reduce inventory levels. This was directly due to severe memory supply constraints and related price increases, particularly localized in the China Android market. Conversely, look at the automotive segment right next to it. It hit absolute record revenues, up 20% year over year, reaching $0.6 billion. This surge was entirely driven by new global vehicle launches that are heavily utilizing their Snapdragon digital cockpit and advanced driver assistance systems. So you have one primary engine faltering due to supply chains and a secondary engine accelerating rapidly.
Hold on. Wait just a second. I'm looking at these overall numbers across the board. The sources say they are generating a massive $12.9 billion in free cash flow over the last 12 months. That is a mountain of cash. And they even increased their dividend payout to $3.68 per share. They are literally printing cash by the truckload. So why in the world is the market going wild with doubt? Why is this stock lagging so far behind other semiconductor peers that are shooting up to the moon?
That is the crux of the current market debate. It is fundamentally a matter of market growth expectations versus current financial stability. The market right now is heavily rewarding hypergrowth in centralized data center AI chips. Think of the companies making the massive, ultra-expensive chips that power the large language models and server farms. Qualcomm, however, historically is an edge device company. While it is completely true that they generate incredible, reliable free cash flow from the global smartphone market, the fundamental reality is that the smartphone market is mature and cyclical. It is no longer a hypergrowth sector. The market is demanding to see mathematical proof that their new growth avenues, specifically automotive and the Internet of Things, or IoT, can completely and safely replace any future stagnation in the handset market. The lag in the stock price you are seeing is essentially a waiting game. The market is waiting for empirical proof of that transition.
Now, what's really blowing my mind here is this valuation paradox we have up on the screen. You just told me a minute ago that the fancy DCF model thinks the stock is 21% overvalued. But look at this PE ratio.
Exactly. This is where the factual data requires a very careful interpretation and why retail investors often get confused. Qualcomm currently trades on a price-to-earnings, or PE ratio, of 23.57x. However, the broader semiconductor industry average right now is a massive 75.81x. Furthermore, Simply Wall Street calculates a proprietary fair ratio specifically for Qualcomm at 35.57x, which is calculated based on their specific earnings growth trajectory and their specific risk profile. So, on a pure PE basis, relative to its direct peers and its own historical norms, the data indicates the stock is significantly undervalued. You have an undervalued PE metric screaming buy, while a conservative discounted cash flow model is screaming overvalued. This mathematical paradox is the exact reason why the stock price is swinging so violently day to day. Traders are literally fighting over which metric is correct.
Unbelievable. So what you just said basically means the math nerds on Wall Street can't agree if the stock is a dangerous value trap or the absolute bargain of the century because it completely depends on which calculator they decide to use that morning. I love it.
Okay, clearly the spreadsheets are fighting each other. It's time for Stage 3, Industry, Environment, and Economic Moat. Let's look at the actual physical world outside of these financial models.
To accurately evaluate their economic moat, we have to look at the massive technological changes happening right now in the real world. According to the company's strategic roadmap, we are moving from a paradigm where AI lives exclusively in the cloud to a paradigm where AI lives and processes directly on your personal device.
Oh, I see. This goes right back to that agentic AI thing you mentioned earlier in the agenda. Okay, explain this to me like I'm 5. What exactly does agentic AI mean for my actual phone in my pocket?
Let's refer directly to CEO Cristiano Amon's specific statements from the recent earnings call. He outlined clearly that agentic AI is the next massive, undeniable megatrend for the industry. Currently, when you ask an AI a question on your phone, the data goes up to the cloud, processes there, and sends back an answer. It requires a constant connection and has latency. Agentic AI means you have intelligent AI agents running continuously in the background of your device's local hardware. These agents constantly feed sensor data into context, they orchestrate multi-step tasks without your prompting, and they do it all locally for maximum speed and absolute data privacy. Amon stated factually that today's current installed base of smartphones and PCs were simply not built to handle these specific, heavy new capabilities. This means, mathematically, every single smartphone, PC, and connected car will eventually require a hardware upgrade to function in this new ecosystem. This is the core objective of their AI pivot. They are attempting to force a massive, global consumer hardware upgrade cycle driven entirely by the need for continuous background AI processing.
Okay, a forced, massive global upgrade cycle sounds like an absolute gold rush for whoever makes the chips. But what stops someone else from just swooping in and stealing their lunch? What is their unique, irreplaceable weapon?
Their advantage is proven by the numbers and their long history of execution. Their economic moat consists of 3 specific pillars shown in the data here: unmatched technology and intellectual property, massive customer reach, and unprecedented scale. In the earnings presentation, management specifically highlighted their unparalleled connectivity solutions alongside their custom silicon capabilities. You see, they don't just design a standard processor, they design the CPU for general tasks, the NPU specifically for AI workloads, and the modem for 5G connectivity, and they integrate all of them seamlessly onto a single platform. The data proves this is working. For example, their automotive design pipeline currently has a stated secured combined revenue target of $22 billion by 2029. Major global automakers are choosing them specifically because they offer a fully integrated, tested platform from the silicon all the way up to the software, not just a box of isolated, disconnected chips.
Okay, hold on a second. We are getting way too optimistic here. You know, my job is to force the bearish view. Every single superhero has kryptonite. Nobody is invincible. What are the fatal weaknesses here? If everything goes wrong, what is the specific thing that could completely derail this company? That is a necessary perspective. We must remain completely rational and look at the explicitly stated risks documented in their SEC filings and independent market reports. The fatal weaknesses here are primarily twofold. First, the threat of vertical integration by their own massive customers. Key handset customers are actively pouring billions of dollars into trying to build their own in-house chips, specifically to replace Qualcomm's hardware. If major handset makers successfully bypass Qualcomm Snapdragon processors with their own internal technology, Qualcomm's primary revenue stream will mathematically plummet. Second, we must look at their QTL licensing business. This division operates on incredibly high profit margins by licensing out their massive, foundational patent portfolio to anyone who makes a phone. However, this division constantly faces immense legal, antitrust, and regulatory pressures worldwide. If foreign governments or major OEMs successfully challenge and dismantle their royalty pricing models in court, it fundamentally damages their most reliable and profitable revenue stream. Oh, wow. So what you just said basically means their biggest, most important customers are actively, secretly trying to fire them, and global regulators are constantly breathing down their necks, trying to cut their profit margins. Got it. That is definitely serious kryptonite.
We need the absolute bottom line now. Let's move to stage 4, the 3 survival scenarios. Where is this actually going?
Based strictly on the factual data, the conflicting valuation models, and the current industry environment we've outlined, we can confidently forecast 3 specific scenarios. Each of these scenarios requires a very specific set of preconditions or triggers to materialize in the real world. Let me break them down logically.
All right, give it to me straight. Start with the absolute best case bull scenario, then give me the base case, and finish with the terrifying bear case.
Let's begin with the optimistic scenario. In the bull case, the absolute trigger is the successful, rapid, global adoption of agentic AI. If consumers widely realize their current phones physically cannot handle these new background AI agents, and a massive, urgent hardware upgrade cycle begins, Qualcomm's handset revenues will surge past expectations. Concurrently, if their automotive segment successfully executes and hits that secured $22 billion target by 2029 without delays, the broader market will fundamentally re-rate Qualcomm. They will transition from being viewed as a stagnant mobile company to being praised as a true AI edge computing leader, pushing their PE ratio much closer to the industry average of 75x, resulting in massive stock appreciation. Now pivoting to the base case, which is statistically the most likely future based purely on the current data trajectory. Here, the agentic AI upgrade cycle is real, but it is gradual over several years, not an overnight boom. The memory supply constraints in the China Android market resolve slowly over the next 2 fiscal quarters, exactly as management estimated in their call. The company continues to reliably generate roughly $12 billion in free cash flow annually, and the stock price naturally gravitates toward the conservative DCF fair value estimate of around $168.50, offering modest, stable, but unspectacular growth. Finally, looking at the bear case. This highly pessimistic scenario materializes only if the specific risks we discussed become reality. The exact trigger would be a major, top-tier handset customer finally successfully deploying an in-house modem or processor at massive global scale, thereby cutting Qualcomm out of millions of devices completely. If you combine that catastrophic loss of market share with prolonged, multi-year memory supply chain issues that continue to crush short-term handset sales, and a failure to gain any meaningful traction against competitors in the data center AI space, the stock would face severe sustained downward pressure as their earnings multiple contracts heavily.
And honestly, this brilliantly illustrates exactly where we are sitting today as investors. To summarize all this complex data and all these fighting spreadsheets into one single sentence, I have to quote the legendary Benjamin Graham. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Right now, looking at that crazy chart, the market is purely voting based on daily AI hype and short-term panics over memory supplies in China. But in the long run, the market is going to put this company on the scale. It's going to weigh those actual cash flows, that massive $12.9 billion in free cash, and it's going to weigh whether or not this agentic AI revolution actually forces all of us to go out and buy brand new phones. That is a highly accurate, fundamental assessment of the current financial reality. The long-term weight of this asset will absolutely be determined by their empirical execution on edge devices and in the automotive sector, not by today's sentiment.
Exactly. And that leaves you, the viewer, with clear, data-driven grounds for making your own investment decisions. You aren't just guessing anymore. You know exactly what the triggers are, you know the fatal risks to watch out for, and you fully understand the crazy valuation paradox driving the swings. Thank you so much for tuning into today's Explainer. We really hope this helped clear the fog. Your subscriptions, your likes, and your comments are a huge, massive encouragement to us and help us keep digging into the data for you. So let us know down below in the comments. Do you actually believe this edge AI revolution is real, or is this just another massive Wall Street hype cycle? Are you betting your money on the bull, or are you siding with the dare? Let's get a conversation going. We'll see you all next time.